My most recent buy and my largest buy right now is a tech stock that I believe is at least 30% undervalued right now. So even taking away all the great growth and innovation this company has, right now I believe we'll get a minimum of a 30% gain on these shares because the stock is about 30% undervalued, and the market over time will value this stock appropriately. But right now we've got a great arbitrage opportunity where we can take advantage of an extremely mature, undervalued tech stock that's honestly one of the most important companies in the entire world. And not only is this stock undervalued as it relates to its historical averages for multiples, but also it's undervalued in relation to its peers. I'm excited to dive into the video, but first, if you're not subscribed, go ahead and click that subscribe button. We're a little bit over 7,400 subscribers on the channel here, and I'm trying to hit 10,000 by the end of the year, so help me out on that goal by clicking that subscribe button. Also, if you want to hear about all the stocks I'm buying, selling, holding, any market commentary I've got, news, updates, go ahead and join the Patreon with the pinned comment down there and the link in the description. Patreon members probably have a really good idea of what stock I'm talking about in this video because I posted about this multiple weeks ago in the Patreon. That's definitely the first place I post any new buys or sells or research work I'm doing. That's where I share it first. So if you want access to that, go ahead and join the other 157 members we got in there with the link in the pinned comment down there. Let's jump into the video. So this stock that I'm buying heavy right now is actually a big tech stock. One of the very few big tech stocks I hold in my portfolio right now. And this is actually the second time I felt this position. The first time I bought in the pandemic crash in 2020, and I sold about 16 months later when the stock had nearly tripled up in late 2021. I hadn't held shares since 2021, and I just recently bought the stock again on June 16th, and I've been buying heavy since that day. And right now, my average cost is $176.50, so we're basically flat on this position. And the stock is Alphabet, which is a parent company of Google, and this is ticker GOOG. Stock price has struggled a lot lately. Year to date, the stock's down almost 7%. Over the past 1 year, the stock's down a little bit less than 4%. But of course, over the past 5 years, the stock's doing very, very well, up 139%. And I think if we look out about 12 to 18 months from now, the worst case scenario is about a 25 to 30% gain unless we have some kind of crazy recession. Before we dive into the valuation metrics and what makes me say that this stock is roughly 30% undervalued right now, first, I want to talk about their position and their strength in the marketplace, some innovations they've got, and their growth rates right now. So on this channel, we talk about investing in stocks that are leaders in their space. We talk about stocks that have best of breed products. We talk about stocks that have very strong moats around them that are going to be very, very difficult to disrupt. There is no company with a stronger position on all three of those fronts than Google, okay? When we look at the most viewed websites in the entire world, one of them you're on right now watching this video, which is YouTube. But that's not the number one. Of course, the number one is Google, and the number two is YouTube. And as you know, they use these platforms to serve up ads to people who are using the products. That's where the high majority of their revenue comes from. When you take Google search, YouTube ads, and Google Network, where they show Google ads on other people's sites, those three things combined brought revenue of $66.8 billion. With Google subscriptions, platforms, and devices bringing a total of $10 billion, and then Google Cloud brought a total of $12.26 billion, combining for total revenue of $90.2 billion in Q1 of 2025, up from $80.5 billion in Q1 of 2024. So the notion that I've heard a lot is that Google is a dying company. Is a dying company one that's increasing their revenue by $10 billion over a 12-month span? No, absolutely not. This is still a company that is in a growth phase. Are they growing as much as they were in 2012, 2013, 2014? No, definitely not. But they've still got very respectable growth for a company that has revenue numbers nearing $100 billion per quarter. Once you get to those levels, it's not possible to grow revenues by 40 or 50% anymore like they used to way back in the day. But to say that this company is dying, to say that this company is a dinosaur, not even close. And another thing that was brought up with Google a whole lot over the past few years is that ChatGPT is the Google killer, and they're going to destroy Google. They're going to take all of Google's revenue. They're going to take all of Google's search away from them, and people are just going to use ChatGPT. I mean, at this point, we can pretty much say without a shadow of a doubt that that's not true whatsoever at all. Google is still in an amazing spot in terms of their position of power in the marketplace. And the AI products they've rolled out have been huge successes. In their Q1 earnings report, the CEO said, "We're pleased with our strong Q1 results, which reflect healthy growth and momentum across the business. Underpinning this growth is our unique full stack approach to AI. This quarter was super exciting as we rolled out Gemini 2.0, their most intelligent AI model, which is achieving breakthroughs in performance and is an extraordinary foundation for our future innovation. Search saw continued strong growth, boosted by engagement we're seeing with features like AI overviews. I'm sure you've seen that whenever you type something in on Google. Oftentimes it'll pop up an AI overview where it's basically taking the top few search results and it's putting it all together into like a bullet point list for you to get your answer even quicker, which is what people want when they're going to Google. They want their answers quickly. Obviously, they want accurate information as well, but they want their answers quickly. They say here that Google Search now has over 1.5 billion users per month, and a lot of that growth and engagement is due to those AI overviews. They have over 270 million paid subscribers, mostly due to YouTube and Google One, and they say that cloud grew rapidly with significant demand for our solutions. Also, cloud profitability grew like crazy. We'll look at that here in just a second. Let's jump into the numbers a little bit more. Revenue, like we said, was up nearly $10 billion, which was a 12% increase year over year. Operating income was up over $5 billion in a one-year span, and operating margin expanded by 2%, which is very impressive, all the way up to 34% operating margin, up from a 32% operating margin in Q1 of 2024. Net income for the quarter was up over $11 billion when you compare it to Q1 of 2024, all the way up to $34.5 billion of net income, and that equates to $2.81 of diluted EPS, up from $1.89 of diluted EPS in the year ago quarter. And we can get a little bit more detail with the two different business segments. They've got Google Services, which is the high majority of their revenue and profit right now, and then they've got Google Cloud, okay? So for Google Services, revenue was up 10% year over year, and operating margin for this segment was up almost 3% year over year, which is a very impressive margin expansion in a 12-month span. Now, when we go to Google Cloud revenue was up 28% year over year, which is the same growth as they had last year, but their operating margin absolutely exploded. Last year, Q1 2024, they had a 9.4% operating margin on Google Cloud. Now that exploded all the way up to 17.8% operating margin. This margin expansion story is not going to slow down with Google anytime soon. This company is unbelievably efficient, and a company like this benefits from economies of scale in a major way. So the more they grow that revenue, the more potential they have to actually expand their margins even more. Oh, and by the way, I forgot to say this earlier, but that EPS growth we saw from $1.89 to $2.81 was a 49% increase year over year. That is more than 4x the revenue growth they have. They have 12% revenue growth, but their EPS growth is 49%. Whenever we have a company whose EPS is growing 2 times as fast as their revenue, that's considered a really, really strong business that's extremely efficient. But with Google here, we've got a 4x. The EPS is growing 4 times faster than the revenue. That is absolutely amazing and should not be overlooked, and definitely should be taken into account when we look at the valuation metrics, which is what we're going to look at right now. Why do I believe the stock is undervalued? Average PE of Google over the last 10 years is 28.18, okay? The median over the last 10 years was 26.2, all right? The current price to earnings ratio is 19.71, and that is roughly a 30% lower PE than the historical average. And it's roughly 25% lower than the median over the last 10 years. And the forward price to earnings ratio is even lower than that, of course, because they're growing their EPS very impressively. So the forward PE is about an 18, and the 2-year forward PE is about a 17. Now, in comparison to peers, they're also undervalued. I've got 3 stocks to compare here: Google, Microsoft, and Apple, 3 big tech stocks. So trailing 12-month PE for Google is roughly a 20. Trailing 12-month PE for Microsoft, about a 38. And trailing 12-month PE for Apple, about a 32. So very much undervalued when we compare it to Microsoft and when we compare it to Apple. Forward PE, 18 for Google, about a 35 for Microsoft, and about a 28 for Apple. 2-year out forward PE, roughly a 17 for Google, roughly a 31 for Microsoft, and about a 25 for Apple. So over the past 12 months, over the next 12 months, and over the next 24 months, Google is undervalued on a price to earnings ratio in comparison to their peers. And this is with higher EPS growth over the last 12 months and over the next 12 months that we're about to see. Google's EPS growth over the last 12 months was more than 35%. Microsoft, only 12%. Apple, their EPS actually decreased over the last 12 months. In the year we're in right now, fiscal 25, Google's expected to grow earnings by roughly 24%. Microsoft about 15%, Apple about 16%. The next 12 months, Google then comes down to about 10%, while the other two are about 14 or 15% EPS growth. Is that 9% accurate? I'm not so sure. There's a lot of fear baked into Google, like we were talking about earlier with ChatGPT and disrupting search. That is getting disproven very quickly. They've had crazy EPS beats lately. Check it out. Q1 of 2025, they had a 40% beat in comparison to the analyst estimates. Analyst EPS estimates are still on the floor for the next 12 and 24 months. That script is going to get flipped, and I would bet anything that 2026 EPS growth rate of 9% is way too low, and analysts are way off on that number. Also, their revenue growth is comparable to Microsoft and way above Apple. Check it out here on screen. With higher gross and net margins than Apple, the trailing and forward price to sales ratios are still way lower. Apple's sitting at a 7.5 roughly trailing 12-month price to sales ratio and a 7.3 forward price to sales ratio, while Google is sitting at about a 6 trailing 12-month price to sales and about a 5.5 forward price to sales. Also trading way cheaper when we look at price to book and price to free cash flow. And their dividend payout ratio is way lower at an 8%, with Microsoft at a 24% and Apple at about a 16%. So they've got more opportunity than both of those to grow that dividend as well. I'm not buying Google necessarily for the dividend, but it is a nice bonus on top of this undervalued asset we're able to pick up right now. And if you haven't looked into Google stock in a while, you might not have even known that they pay a dividend. They started paying that dividend in 2024. That's just another way they're able to return capital to shareholders on top of their $70 billion buyback that was approved in Q1 of 2025. And since no investment decision is complete without taking a quick look at the balance sheet, let's dive in there real quick. This company has the third highest amount of cash on hand of any public company in the entire world. Right now, they've got $95 billion in cash, with only $28 billion in total debt. That total debt that they have is less than their quarterly net income. That's a crazy statistic. This is one of the best balance sheets in the entire world. And if they don't have anything to do with that $95 billion in terms of innovations or buying out other companies, they can always return that capital to shareholders through buybacks and through dividends. I'll be buying this stock heavy all the way up to $200 a share. Once we hit roughly 200, I'll buy a little bit lighter. I'll continue to pick up shares until I'm at a position where I have roughly 4% of my total portfolio value in Google stock. Let me know in the comments below if you hold Google stock, and if you do, how long have you been holding? I know some people who have held Google for more than a decade, and it's treated them extremely well, and now they're getting paid that dividend on top, and it's still a very, very impressive growth company with expanding margins, and it's undervalued right now. If you made it this far in the video, consider checking out the Patreon with the pinned comment down there or the first link in the description. We'd love to have you over there. I appreciate you being here in a major way. Thanks so much. Have a great day.